And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning. I'm Lance Roberts with The Real Investment Show, and today is one of our very special interview editions of The Real Investment Show, and we're very lucky today to have Axel Merk with us. He is the Chief Investment Officer, Portfolio Manager for Merk Investments. You're very familiar with him. Of course, he's been all over the media a lot of times, and you've seen lots of podcasts with him in various places. So we're very fortunate to have him with us today to talk a little bit about employment, the Fed, gold miners, kind of just, and as always is the case, I'm a technical analyst in a lot of cases looking at particular issues. And so when I talk about gold, a lot of time it's from a technical basis. But again, we'll have Axel today kind of work with me as well to go through the fundamentals of all this as well. We're going to talk a little bit about macroeconomics, markets, and kind of where we're going to wind up here as well. Axel oversees about $2 billion in assets, frequently offers his expertise on insights on viewers of macro markets, economy, et cetera. And again, very, very honored to have him with us today. Axel, good morning. How are you?
Good morning, and just to chime in on that, one sign that this market has been hot in the gold and gold mining space. As of last night, we managed over 2.8 billion.
Nice.
The 2 billion is a few weeks old.
Well, there's nothing like good capital appreciation to increase AUM.
It's crazy. It's crazy.
Congratulations. That's quite awesome. Of course, if you ever want to find more out about Axel Merk and his products, simply, you can look him up on the web, go to his website, and, all of his products are there, et cetera. So again, more about Axel Merk on his website if you want to check that out as well. So we're talking this morning on Tuesday, September the 9th, and this morning was a very interesting report out from the government, which is we did the annual revisions to the Bureau of Labor Statistics. There's been a lot of debate about the BLS Employment Reports. Just recently, President Trump fired the head of the BLS on a weaker than expected employment report. There's been lots of conversations over the last couple of years about, the BLS reports aren't real. There's all these problems with it. And, and today almost kind of justified some of that narrative because we saw the largest negative revision to jobs in history of 911,000 jobs over the last year from April of 2024 through this year that basically didn't occur. This follows, by the way, on the back of the previous largest negative revision in history, which was 818,000 jobs in the last revision. So 2 years in a row, we've had record negative revisions to the employment report. Kind of just what was your takeaway from this, but also B, I want to get into talking about what does this potentially mean for the Fed, as this has been one of their kind of points for not cutting rates has been a strong employment market, which apparently isn't nearly as strong as they thought it was.
Well, the most noteworthy thing from what you just said is that it's very interesting. Mm-hmm. The reason I point that out is that these benchmark revisions have happened every year. And it is this year that it gets everybody's attention because obviously of the administration's criticism of the BLS. But this is part of what the pencil pushers at the BLS are doing, these quote unquote benchmark revisions. And one of the things we do here at Merk Investments is every other week we have a talk with Bill Poole. Those of you old enough may remember that he used to be the president of the St. Louis Fed, and he was considered to be one of the hawks. He's also a brilliant mind. He's like an open textbook on anything that's ever happened at the Fed. He knows anything about any meeting, and he's in his mid-80s by now. That said, he tries to explain to us the details of these benchmark revisions every year when it comes up. And I follow this stuff. I don't fully understand it. But
that's okay. Neither do I.
But the point of it is, of course, that when these numbers are released, there's a methodology behind it. And the academics have decided that this is how we're supposed to do it. And it's a rather imperfect science. And the one broader point, right, not to get into too much detail, is I think the one thing we should keep in mind, the reason why the market pays attention to the payroll data is not that they're so accurate. It is that they are so timely and give one of the most timely insights into what's happening to the labor market. If we have these numbers with 3 months delay, they're much less valuable than they're imminent. And in my view, what is more important than the accuracy is that the market fully understands the methodology behind it, because then the investors can make up their own mind on it. Now, to the broader point, to the downward revision, yes, that is, of course, substantial. This market has underlying weakness. Remember, we've talked about this recession that has never come, right? And part of the reason, by the way, is because the Federal Reserve, ever since the Bernanke days, has ever more micromanaged this economy. And sure, when we put a rescue out to the banking system and they mismanage interest rate risk, we're not going to have a recession necessarily. But it doesn't mean that there aren't some deep structural problems. And then separately, of course, yes, the economic data have a problem. And if I can expand for a moment, the reason why we have all these data, I would credit President Hoover. From many, many decades ago, 100 years ago, Hoover believed we need national data on the economy, on health, so that the government can help more. That was kind of the golden era of experts. And now, 100 years later, we are dismantling the belief in experts, and everything we see and hear is bad. And so it's not too surprising. Now, the good news is there are plenty of private data sources. And from as an investor's point of view, I care about transparency. I know these data are imperfect, but yes, this economy is not as strong as it has appeared.
Right. And look, I think that's a great point. So real quick, I want to go back to what you said earlier, is that these revisions happen every single year. This is a chart of the annual revisions to the data. And this chart goes back to 2006. And it just shows you that Axel is absolutely correct in what he's saying, is that every year we have revisions. And more often than not, those revisions are negative. Right. There's a few years that we have a positive revision to the data, and economists actually underestimated the strength of employment. But most of the time, the employment data is overstated to begin with in these negative revisions. It's kind of align it back to reality of what's going on. So this isn't a new thing. It was just that, again, it was the size, and most importantly, to Axel's point, the reason that it was so paid attention to right now is because of A, the president's recent firing of the head of the BLS on the employment data, but B, also because the market is so focused on what's the Fed going to do next. I mean, that's every day. It's like, doesn't matter what the economic report is, whether it's in CPI or PPI or the bond auction data, or whether it's the employment data. It's like, okay, that's great, but what does that mean for the Fed, right? And so we go to the CME and we're quickly looking at what are the odds now for a rate cut at the next meeting, because what the markets are thriving on at the moment is more liquidity and more monetary accommodation. And that's what the markets have been trading against and really front running against over the last several months. So it's a great point. And Axel, really, this is something that I try to get across to my listeners a lot of times, is that, whether it's everybody, CPI data comes out and says CPI is 2.6%. Everybody's like, hogwash, right? It's real inflation is this. And have you not been to the grocery store lately? This is what's going on at the grocery store. And what I try to get across to my listeners is that it's okay to disagree with the data, but what the market's going to trade off of is that data. And whether it's gold prices, or whether it's the stock market, or whether it's the bond market, or whatever it is, the bond market's going to look at the markets are going to look at the data as it's presented. Is it always accurate? No. Are there problems with the data, whether it's employment or inflation? Yes. But it's the data that we have to work with, and it's the data that the market's going to work off of. So personal beliefs need to be set aside about whatever you think about, because those emotional biases lead us to make bad decisions over time. It's like, I don't believe the inflation data, so I'm going to do something else. And then you buy assets that aren't necessarily working in the markets right now. So it's important to focus on that. You don't have to agree with the data, but it's important to at least understand the data and how the markets are going to relate to it.
If I can just add to that, the one thing that has changed over the years is that the Federal Reserve used to have much better data available. And this is not about the qualifications of the academics at the Bureau of Labor Statistics. It is that the market used to give you a lot of information. And ever since the financial crisis, the Federal Reserve has stepped in to manage ever more aspects of the yield curve, of the economy. When you pay interest on reserves, you're greatly simplifying the system. It used to be that the Treasury desk at the New York Fed used to intervene in the market to shift the Fed funds rate around. It was very laborious. The folks think that today's system is easier, but the key difference is you used to have insight into trouble spots in the financial system. And we are the state where the Fed doesn't even know how large the balance sheets should be so that there's enough liquidity in the system. And so what ends up happening is that the debating club at the Fed is reading the tea leaves just like everybody else. They're looking at past data rather than looking at real-time data that the market gives you, because they're just not as meaningful. And to kind of talk about the Fed here a little bit, there's one candidate to succeed the Fed, Kevin Walsh, who's the only one who was, before his candidacy was in the news, talked about how the Fed needs to have other data sources, real-time data on the economy. I mean, there are plenty of data available on real-time retail sales and this and that to have a better assessment of where the economy is. And the Federal Reserve is just living in the last century with fewer of the tools available. And so, and so institutionally, they're always going to be late, and they're going to be reading the tea leaves, and the practitioners in the markets are a step ahead of them. The reason why we pay attention to the Fed, though, is because they control the bazooka, right? They set the benchmark risk-free interest rate, and everything is priced off that. Now, the one thing, the quote-unquote good news, if anything, has been is that this year, the Fed has not been as much in the news, aside, of course, for the drama surrounding who is going to be doing what. But people have focused much more on tariffs, on this and that, and you may like it or dislike it, but I don't think it's a bad thing that whether the Fed actually going to cut rate or not, yes, it is important, but the markets have been far more interested on what's going to happen on certain fiscal items.
Well, and again, what we've got coming up, of course, is just next week. We've got the September Fed meeting, and of course, the question is, will they cut by 25 or 50 basis points, or will they cut at all? Will they pause for another meeting? The data certainly supports right now that the Fed should cut rates, and it was interesting. I was just doing some work over the weekend. And the 2-year Treasury rate has a very high correlation to the Fed funds rate. And there's about an 80 basis point spread right now between the Fed funds rate and the 2-year Treasury rate, which suggests that the Fed is potentially behind the curve here once again, which isn't surprising. They're always, as you said, they're kind of always late to making policy changes. And if the recent employment data is any indication about what's going on in the economy, the risk of a much slower economic environment in the near term seems to be the bigger risk than not.
Yes, and I mean the market is pricing in a 110% chance of a 25 basis point rate cut. The reason it's over 100% is because technically it could be a little more than 0.25%. That's been priced in for a while, although these odds have gradually been increasing as some of the economic data have been weaker. There have been some market reaction to the revision, to the benchmark revisions in the in these numbers. But overall, yes, the Fed is going to cut rates. Of course, the Fed has this dual mandate. It used to be that the Fed would only talk about inflation. Remember Greenspan saying if we keep inflation under control, then unemployment is going to take care of itself. Today's Fed is talking up both of these. Indeed, a few years ago, Powell was talking up, we got to help underprivileged people and this and that. So going way beyond what you can even do with the Fed policy. And by the way, it is helpful to remind ourselves sometimes what monetary policy should be or is. Monetary policy is about the amount of credit in the system. It's about interest rates. It is not about allocating money to a specific sector of the economy. That is fiscal territory. And ever since 2008, the Fed has veered ever more into fiscal territory. By the way, buying mortgage-backed securities, even, in my view, is fiscal policy, because you're allocating money to the mortgage sector. And not surprisingly, you get more pushback from the fiscal side. So this politicization of the Fed, we can criticize Trump all we want, is in significant part due to the Fed's own doing for having moved on to fiscal territory, that they as unelected officials do things that elected officials should do. And to just expand on that for a second, the reason why intervention by somebody credible is not helpful at the Fed is because it makes Fed policy more expensive. When the Fed is independent, the Fed chair can say a few words and the market is moving. Whereas when you have credible interference, then you might have to intervene in the markets, do more. So it increases the cost of doing business. That doesn't mean that criticism isn't warranted. And by the way, the interference of the Fed has a long, long history. It's politically very attractive to blame the Fed for just about anything that's happening.
You and I have been around the block for a while here in terms of the investing markets, and things have changed over time. And after the financial crisis, the way the market operated certainly changed, with the Fed keeping interest rates at zero for literally an entire decade. Multiple rounds of quantitative easing, expanding their balance sheet, of course. All these influences, to your point. And then, of course, not to mention the monetary, the fiscal policy that was coming in from the government, whether it was HAMP or HARP or TARP or just latest the CHIPS Act or the Inflation Reduction Act. And it's distorted markets. And what's really fascinating right now, and this has really occurred just in the last 5 years, you can take some simple asset classes that should correlate to each other as an example. And one thing we've seen over the last 4 or 5 years in particular is this really increased level of speculative risk brought into the financial markets, and really kind of all asset classes. What you see it in gold, you see it in Bitcoin, you see it in stocks, the NASDAQ. And you see this policy because it's investors now kind of believe is like, oh, don't worry about it, because if something blows up here, it's fine. The Fed's got my back. They're going to come back they'll cut rates to zero and they'll do QE and all this. And there's this what's called moral hazard now has really entered the markets. And again, if you just take a look at some correlations, home builders as an example. Home builders are doing fantastic right now, but look at lumber prices. They're absolutely crashing. Historically, prior to 2022, those had a very high correlation to each other, which makes sense, right? If I'm building houses, I need lumber, so those should kind of correlate with each other. But now you got this big gap between two sectors of the markets: oil prices and energy stocks. Oil prices have been in a bear market, and energy stock prices are deviated now from the underlying fundamental commodity of where these companies generate earnings from. And it seems to be that when you look across these various asset classes, you're seeing this kind of moral hazard that's really developed because of this idea that the Fed's always got the investors' back. And I'm just wondering, when that, because, we've seen this before. I'm just kind of wondering when or if this ever ends, or is this the new market that we're dealing with?
Well, if you take the tech bubble in the 90s, right, Greenspan gave his irrational exuberance speech years before the tech bubble burst. Timing when a bubble bursts is extremely difficult, and you can have plenty of guests on your show that suggest that prices are reasonable and there's justification for all that. The folks at the Fed that control the bazooka, they are extremely reluctant to manage asset prices. And we'd like to criticize them. Oh, they didn't do anything about the housing bubble or this or that. By the way, Fannie and Freddie didn't file financial reports before the 2008 financial crisis.
That's right.
And so there are some excuses that some of those folks have. And so if they just stick to their guns and focus on inflation the way that they look at inflation, then they exclude asset price inflation. I happen to think that when you have suppressed volatility, when you have credit spreads to be abnormally tight, then that is something the Fed could look at, and that, of course, indirectly does affect asset prices as well. If you look at the space I'm focused on, gold versus gold miners, price of gold has obviously soared, and the gold miners have gone up. but nothing compared to the sort of margin expansion that's been happening in that space. And then if I wonder why that has happened in that space, it's presumably in part because investors have been burned just too many times. These miners just didn't perform. And by the way, the big miners that get a lot of the money these days, they underinvested. They are not replenishing their reserves. By underinvesting, by the way, they get their balance sheet in order, but they provide less leverage to the price of gold. And so there are always company-specific things that I'm sure you can also find in other sectors. Regarding the speculators, they mostly, and I presume that's mostly your field, right? They like a good rally or a good plunge. And so when I look at the gold investor, that historically was kind of the gold bugs and the speculators, they go to the miners, right? But then the gold miners were in a bear market for many years, and you had an opportunity in the meme stocks and whatnot. Mm-hmm. If, and I'm saying if, let's assume for a moment gold and gold miners continue to do very well, and let's say crypto assets and meme stocks perform poorly, those guys are not very loyal. They'll switch over. And then, of course, what that does is that increases volatility, and it feels great on the way up, but of course, fasten your seatbelt on the way down. And the Fed can muffle the speculation with tighter monetary policy, but of course, we are in a phase right now where everybody expects an easing phase, right? And then on top of it, yes, I indicated that the Fed is ever more micromanaging the economy. I mean, if you bail out banks that have mismanaged interest rate risk, what better way is there for a bailout, right? And what can possibly go wrong if you pile in money to anything? And by the way, what happens when quote unquote everything goes up? You start investing not based on fundamentals, but based on whatever you love. You love green energy, so you pile your money into green energy. You love this area, you put it there, because nothing ever goes wrong, right? And so you're the smartest guy at the party, and you do whatever you feel like. Mm-hmm. In our industry, by the way, in my sector, and that's broadly active management. Active management is very counter-cyclical, right? In a broader bull market, why you do anything other than the index? It's when times are tough, then people are flocking to active management. And 2008, by the way, was a great year for us. Year to date has been a great year for us, which usually is a bad indicator for the broader market. But so far, obviously, the broader market has been holding up. Yeah.
And you know, it's interesting because you made a comment. You said, well, the Fed doesn't really target asset prices. But Ben Bernanke in 2010 said, well, the reason that we're doing quantitative easing is to boost asset prices, which improves consumer confidence, which boosts the economy. And of course, every time the market crashes, the first thing they do is cut rates and do QE. So I'm not sure it's entirely true the Fed doesn't target asset prices. I mean, in general, they're not supposed to.
Yes, they don't want to. And then, of course, one of the things that has changed structurally is that much of the spending is happening in the top 1%. Right, and the top earners they are dependent on asset prices rather than on the checks that are coming in. And the more you drive these things to extremes, and 0% policy presumably is an extreme, the more distortions you create in the market. And these distortions go way beyond just financial markets, right? I mean, people on the street, they feel that something is wrong. They can't put their hands on it. But then they're voting for more populist politicians, right? In the US, abroad as well. And now we are stuck with a housing market that is somewhat frozen because we've created all these distortions, and it's not easy to fix it. I've talked to folks at the Fed, and they think that kind of they always worry about today's problem, and tomorrow's problem they'll worry about tomorrow. But there are real implications for real people when they push things to extremes. Yes.
Yeah, and this is kind of where we are right now in terms of the markets. We're seeing a lot of these extremes kind of developing. But let's talk. Let's kind of switch the conversation. Talk a little bit about gold and gold miners in a second because we started to touch on that. But let's go and finish out that conversation. So gold has been doing very well this year. But as with all asset classes, one thing that happens is that we all get really excited about an asset class. It's going up, so we start buying it, and it keeps going up, so we buy more of it. And then eventually you're going to have a correction. And the one thing for investors is they're really bad about managing risk. And they assume they either have to own all of something or none of something. There's nothing, there's, just taking some profits here and there seems to be like a taboo thing. But, in particular, one thing we're seeing really kind of impact, and I see this a lot in my portfolio management and just managing, broadly diversified portfolios, et cetera, that, we're really seeing the impact of passive investing driving asset prices much further than they should be otherwise. I mean, we take a look at valuations, where things are trading on certain, companies, et cetera. You can see that impact. NVIDIA's in 450 different ETFs. So every time somebody buys those ETFs, it fuels the stock price of NVIDIA as an example. Gold miners as a function are a lot smaller percentage of the market than, say, technology stocks. Is the passive indexing effect of people buying, GDX and other gold miner ETFs, et cetera, also helping fuel the stock prices of these miners as well?
So let me give you mentioned numerous topics here. Let me just make a broad point about index investing. I had a brief discussion with William Sharpe, the inventor of the Sharpe ratio in the 90s, and told him about my concern about the chicken and egg problem. Right? When the index is supposed to be the market portfolio and be the best portfolio and so forth, but when you have too many index investors, you're creating distortions, right? If you invest in the index for the sake of it. And he shrugged it off and said, it's such a small portion of the market. Obviously, 20, 30 years on, it's a huge portion of the market. Now, that said, we talk about passive investing, but then more ETFs out there than there are stocks these days. And so even if that quote unquote index is passive, you of course make an active decision as to what index you invest in.
Right.
What's unique about, to answer your question, what's unique about the mining space is that you have a rapidly depleting asset. You take the gold out of the ground, you need to find new gold. And the big miners, they always do what investors want them to do. And so in the previous bull market, they made acquisitions, they overpaid, then they were told to get their act together, the balance sheets look good, but they underinvested. Now they're playing catch up. They invest in these big copper gold projects that have a very different risk profile than historically these gold miners have had. And then when you buy the index, you're getting a package of that. But what you're not getting when you buy the index is you cannot help fund any of these projects. You cannot, an index is not meant as a provider of capital, so to speak. They don't provide in these funding rounds of the junior mining companies, even the GDXJ, and I'm not giving any investment recommendation on any of these ETFs. It's not truly a junior index, right? It is, these are not that small. And they're very interesting dynamics. First of all, the gold and the gold mining investors is often different. They sometimes overlap, and personally I invest in both. But on the gold mining side, the dynamics are very different from the majors to the juniors. The more junior you get at the extreme end, you're literally buying an option of them striking gold, right? And so that creates very, very different dynamics and different segments of that universe. And it used to be that the fellow folks who invest in meme stocks, they used to go to the Canadian exploration conferences, look at the offerings, and then kind of put money down on select companies. It's a very, very interesting space. The way, by the way, in our view, to play that space is to invest in management. The dispersion of returns in the gold mining sector is greater than in any other sector. Which is a very fancy way of saying that active management matters. And what happens in practice is that money, when it does get into the industry, it gets into the majors, and then historically, and I'm not making a prediction here that will play out this time around, it then goes to the junior companies with an amplified effect. And of course, what's been happening is that gold has been soaring. Gold miners have gone up, but by far not as much as the margin expansion is presumed to be. And part of that is investors have gotten burned so many times that they might be reluctant. Usually when the price of gold moves higher, other factors also happen. Governments want to get a bigger share. Employees want to get a bigger share. Commodity prices usually go higher, and it's about 20-25% of mining is energy cost. And so the margin expansion historically hasn't always happened. This time around, a lot of these negative factors haven't played out. And so the margin expansion has been there, but the investor either doesn't believe it or is just paying less for the ounces in the ground. And so it's been fascinating to watch. But the other point is, yes, the sector is tiny compared to the tech sector. And so you don't need much money to go into that sector to have substantial price moves.
Well, again, I was going to, you made the point, which was historically, the margin expansion, and this is always kind of the biz, like gold prices go up, this is going to be great, Freeport McMoran or Barrick Gold, whoever's going to be hugely profitable and have these great returns. But then, employee costs go up, mining costs go up, energy costs go up, extraction costs go up, and those margins never actually matured to where it supported the valuations. And again, we to your point, we haven't seen that occur yet. Doesn't mean that it won't. But that's one of the challenges. And I think that's a great value that you bring into this, and something that is important if you're investing in gold, and particularly gold miners. It's really important that you really understand the fundamentals of these companies, because like Axel said, there's a huge dispersion of returns that come out of that sector. And so there are some really good companies and there's some really not so good companies, and it's important that they're not all going to act the same in an environment like we're in now. So it's important to really understand, and this is why we're an active manager. This is why Axel's an active manager as well, because finding those opportunities are more challenging probably in the mining space than I would suggest that they are in, say, the technology space. Would you agree with that?
Yes, and let me just add 2 points to that. Is you framed that in the context of ETFs.
Yep.
As these companies make it from exploration to development and then go into production, there tend to be bigger investors joining, assigning higher multiples. They tend to be added to indices, not just in the US. We mentioned GDXJ. Australia is very index-driven, the market. Canada is also index-driven, the market. So as these companies get added to these indices, more liquidity comes to that. They might be increasing. So playing the quote-unquote index game is interesting. There's a big reshuffling in the index and GDX happening, and so that can affect companies positively or negatively. And so it's a fascinating area. The other area that to look at is we look at the space as a venture capital light type of approach. We invest in management teams. You mentioned the tech sector. The folks that tend to get money in the tech sector are the folks who have been able to have successful exits before. And so if you have a proven management team, and that might be the scarcest resource in the space, good management teams. And so the good management teams tend to be able to attract money. And you want to go with management teams that go to sources where the next time around they need money, because often they only get funding for a year or two. There's going to be money around as well. And so it's right now the funding window is open and a lot of companies are able to access the markets. In the quote unquote higher for longer environment that the Fed had, it was far more difficult. And while most of the money that these companies raise is on the equity side, I say the juniors in particular have credit risk. Because when the financial conditions are tight, then it's difficult for them to access money. Now, the one exception might be at the higher for longer environment was a very hostile environment. If credit conditions get tight because the economy turns down, well, if the expectation is that the Fed will come to the rescue, actually financing conditions for the junior miners might be favorable because that then that's a good environment historically anyway for the price of gold.
Well, I think that's an interesting point. So, one of the so gold and gold miners have been doing exceptionally well this year. They tend to go through very long periods of where they, kind of just trade sideways for a while. Then they have these really good, strong periods that can last a few years. And we're in one of those periods right now where gold and gold miners are doing very, very well. But if we're worried about an economic slowdown in the economy, or potentially this recession that's supposed to come but hasn't come yet for the last 5 years, if that does happen to show up, what are some of the things that, if I am a gold and gold miner investor and am long this sector, I've got good gains in it right now, what's the thing that kind of worries you, kind of looking forward over the next, say, 2 to 3 years?
Well, first I'll answer a question, I think how you phrased it before about investors not being good at timing the markets and whatnot. My belief is you don't necessarily need to have a good investment process. A mediocre one is okay. What is bad is if you have no investment process.
Well, thank goodness, because mine's only mediocre at best. So
yes, no, and we've all been humbled by the markets over the years, many times. If we are right a little bit more than half the time, that makes us pretty good already. But I say that for a reason, right? Because you talk about risk management. Is you've got to have a notion of risk, and it's probably not just a standard deviation. I like to tell people that if you can sleep with your portfolio at night, and I don't mean the physical gold bar under your pillow, but if you can sleep with the sort of risk that you have, and when something goes up, always think that the same movement could happen on the downside as well. One of the things I like to say, which is a bit controversial, is that when people told investors to double down on their equities in the spring of 2009, I thought it was utterly irresponsible. Now, for those who don't remember, that was the low of the market.
Right.
The reason why I say that is that people often don't take chips off the table during the good times.
Right.
Which means in 2008, they lost substantially more than they were comfortable with. And so if you then tell them to double down on their risk exposure, that's irresponsible. Mm-hmm. The thing you should have done is put money aside, take chips off the table during the boom time, so that then you can put money to work in the spring of 2009. And so similarly, you got to be comfortable with whatever exposure you have and be able to work with that. I happen to be enthusiastic about the junior miners because of that delayed rally in part. I don't see excesses. When companies raise money, they still use very conservative numbers for the price of gold. You don't want to give money to a company that says we need to have a $3,600 an ounce price of gold for them to be profitable. And so that's where we want to see excesses. Now, that said, after a rally like we've had, of course it is possible for the prices to come down even substantially. So you've got to take that risk into account. And one of the things I tell people is that with the gold miners in particular, if you're a technical analyst, and you are one, right? If you can time this thing, good for you. I happen to think it's extremely difficult to time these markets. And anybody who wants to wait until something happens, I mean, the gold market can move 5% in a day, significantly over 10% in a week. And so you got to think about what is it worthwhile, what opportunities you can lose out on, and so forth. My job is much easier. I'm a long-term investor, right? Yeah. It's and that also means I'll be wrong a lot of the time when the market is moving against me. By the way, one of the reasons why technical analysis works in the gold space in particular is because the fundamentals are so simple, right? Because the industrial input is much less. Silver is already much more complicated, has much more industrial use, and it becomes a self-fulfilling prophecy. So I'm not saying that there's no place for technical analysis, quite the opposite. But I am in many ways a simpleton and just like that brick as a long-term investor. No,
and look, so we have a portfolio. It's called we run an all-weather model portfolio, which has gold miners in it, that has silver, platinum, others. as part of that kind of that permanent portfolio structure, and it's a long-term structure. And it's always interesting because, like this morning, I was showing a chart price, a long-term chart price of gold this morning on our show, and if you look at a long-term monthly chart going back historically, its relative strength right now is more overbought than the previous 4 times in history it's been here, going back to 1985. And each time that gold has been this overbought on a monthly basis, you've either gone through a consolidation period that has lasted a couple of years, or you've had a fairly decent price correction. And so, I'll say, look, it's just really overbought right now. If you're long gold, take a little bit of profit. If your portfolio size is 5% of gold in your portfolio, or 10 or whatever it is, and it's now 12, trim it back to your target amount, whatever that targeted amount was that you wanted exposure to in your portfolio, just trim it back to that. Well, as soon as I say that, everybody says, oh, he hates gold and he's saying sell everything. And and again, it's just going back to talking about risk management. We're in really good times right now, and things are doing great. Markets are really overbought on a technical basis. There's nothing wrong with taking a little bit of money off the table. Again, if I take some money off the table today and gold prices do come back, I can buy gold back at a cheaper price, at some point in the future. And for some reason, that's really hard for investors to get their head around. But when the price correction eventually comes, then they're caught into that panic mode of, oh my gosh, I'm losing everything, and now I sell everything, and generally at the worst possible time.
Yes. By the way, fun fact on technical analysis. You presented me as a macro guy, and I am. But in my youth, I did a lot of technical analysis. Indeed, in the late 80s and early 90s, I studied everything that was hip. It was called artificial intelligence, including chaos theory, applied it to the stock market. And I wrote a paper in the early 90s on the fractal dimension of the stock market, which is a degree of self-similarity. And what I proved is that if technical analysis works, you can apply it to tick data as well as to long-term data, because the degree of self-similarity is similar. I submitted it. You're old enough to know that technical analysis of stock and commodities, and they liked it, but they said, well, how do you make money with this stuff? And I said, I don't know. I was a student at the time, right? and so they didn't publish it. But there is value in that sort of analysis, right? I like to get a macro sense of what's happening. Whether that's just to feel good or whether that actually helps is another question, right? Because ultimately the timing is right. I like to look at technical analysis as kind of driving while looking in the rearview mirror, but you want to do that especially when overtaking someone, right? You want to know what's happening and what the environment is, and so on the macro side. The other day, I talked to my wife and says, well, finally, all the things you've been talking about are panning out and so forth. And it says, yeah, no kidding, right? But timing things on the macro side is extremely difficult.
Yes.
And the way as an investor to think about it is, this is all fine if you're a long-term investor. If you go short something, especially if you have a so-called negative carry, meaning you have to pay to hold your position, you've got to have your timing right? So I trust over the years you have talked to plenty of people that short the long bond because they think, oh my God, our finances are a mess. Well, you can do that, but ask these people whether they actually have money on the line doing that, because it's one thing to talk about shorting bonds, another to actually do it. Yep. Because when you do it, you're bleeding money all the time, and you got to get the timing right. Yeah, and exactly. So, and it's just the broader point, right? When you talk to your guests, I think it needs to be clear whether they actually manage money or not, because it makes a huge difference.
Well, no, that's and Axel, that's why I wanted you here today, is to talk to another money manager that's in the business. Because this is one of my big complaints about a lot of the stuff that goes on in the media. There's a lot of people out there right now saying, "Oh, the big crash is coming, and you're going to lose 50% of your money because the market's going to crash." But they never tell you when it's going to happen. They don't tell you why it's going to happen, and they won't tell you when the crash is over and it's time to buy back in. Right? It's just these kind of anomalous views, and eventually someday, they'll be right. We'll go through another financial crisis, but that is useless for helping somebody actually manage their own portfolio.
The value I see in it is I like to hear contrarian perspectives,
sure,
and stress test my own investment process, right?
Right.
And so when I read a book, when I listen to somebody, I don't need to fully agree with them, but if they can get me out of my echo chamber to think about something that I have not thought about, it's worthwhile. It's one of the reasons why I'm on social media, is because I'm not the boss there. I'm the boss of my company, and so people will tell me when I say it's nonsense, right? And so I think it's that sort of feedback that's helpful. And so even if somebody says, "Oh my God, the world is coming to an end," well, why? And if they have a point, well, I can disagree with the timing. I may think the world isn't coming to an end, but it's again, just like the Bureau of Labor Statistics, the data may not be perfect, but is understanding the methodology, you just extract information that you want to from that. The important thing as an investor is that you don't get carried away with what somebody else says, but you just, okay, that's interesting. And now what do I do with this, right?
Yeah, exactly. But that's exactly the point, right? So you and I as active managers, you and I are both managing other people's lifelong asset. This is money they depend on. So we have a huge responsibility to make sure that we do the best job possible for them over time. And most importantly, protect them against, major losses in their portfolio. And the problem I have with people that are just saying, "Oh, the world's going to end," and that have no skin in the game. They don't manage money. They're just writing articles or making videos for clicks and views. I have a problem with that because they don't have any skin in the game. They can say whatever they want, and if they're wrong, nobody holds them accountable. It's kind of like mainstream media, people on CNBC. But for us, it's okay to have that data, and then you and I can go out and we can go do the research and say, okay, are they right? Is this right? What's the data actually say? And then but we're responsible in making that decision. Because if I believe the world's going to end and I go sit everything out in cash, I won't have any clients in a few years, and I've hurt my clients by not having them participate in markets.
Yeah. So two things. First of all, yes, cash. You lose your client if you invest too much in cash.
Yep.
Because people are not willing to pay for it, even when it's the right choice. I'd like to make a point about the world of the end type of investor. And since we're investing in gold and gold miners, as you might imagine, our target audience, there are plenty of doomsday gold bugs in there.
Yeah.
The one thing I like to tell them is that there is no such thing as an investor as the end of the world, because there's always a day after. And we as a society adjust. Like to give the example, right? There used to be one breadwinner in the house in the 1950s. Now you tend to have two, and they may be struggling. If you talk to a 65-year-old that is still going back to having a job, society adjusts, and these people are proud that they're still contributing members to society, whereas a few years ago said, "Oh my God, if you're 65, why on earth do you still have to be working?" Or similarly, if you go to some Latin American economies where they've had hyperinflation and whatnot, life continues, right? There's always a day afterwards, and so it affects political stability, it affects all kinds of things, but there is the folks who think there's a great reset or this or that, or the folks that think that there's a huge global conspiracy. I mean, we can't agree on anything in any country, on anything short term. How on earth can anything be coordinated globally, right? And if you are a gold bug that thinks we should go back to gold standard, why do you think the government is going to bail you out with a gold standard when everything the government is doing is wrong? Have your own gold standard and live by that, if that's what you believe in. Right? And so it of course helps to simplify things and say, okay, some bad stuff is going to happen. What do I do about it? But I do like to encourage people to think that through, what it actually means, what they're saying. Yeah,
I agree, and that's such a great point. Axel, we're running a little bit long on time here. Is there anything we haven't covered that you wanted to cover, or anything that we need to touch on?
Well, the best investment advice ever that I like to give, and my speech is regulated, so what I'll tell you is going to stun you. Now, the best investment advice ever is to invest in yourself, because you're a fixed income generating machine. And the more you invest in yourself, that is something you can control. When you buy something with a click of a button, you usually don't have much control over it, other than you can sell it again. And that means both in terms of your skills, but it also means in terms of your health. That is one of the things that is often not mentioned on a financial program. But I do think that especially when the future is uncertain, which I guess it always is, right? Control the sort of things you have control over. And if you can generate income through your labor, that is something that I think people are underestimating. And I think people should look at that in the context of the risk that they can take in a portfolio. It's one of the reasons why younger people can take greater risk, right, in a portfolio, because they have that earnings power. But especially as one is maturing, it is something to think about of how is one's earnings power and what does that mean? And so to not just think about the short-term trade or the long-term allocation to anything else, but it is very relevant in the context of one's individual situation.
Yeah, that's great advice, Axel. If you're not familiar with Axel Merk and would like to learn more about him, go to his website, Merk Investments. You can find out all about his different ETFs and portfolios that he manages. They're all there at the website, Merk Investments, MERK.
Merkinvestments.com. Yes, Google my name if that's easier. We have a free newsletter. Sign up for that. We can't discuss the products here. I'm on Twitter at Axel Merk. You can follow me. I'll chime in. Caution, when a central bank meets, I tweet like crazy because it's one way for me to take my notes. But it's on Twitter I can chime in on the most current events. But yes, we manage 2.8 billion in gold and gold mining, and it's been a very interesting journey.
It's been an honor having you here on the show today. Love to have you back as things kind of develop and go on. We'll certainly kind of catch up on things, but it's been a really great honor to have you on the show today, and we appreciate it very much. That wraps up the Real Investment Show for today. So again, be sure and get by the website, realinvestmentadvice.com. Click on the like button for this interview right now. Like and subscribe to the channel. Those help us keep the videos going, help promotes our views as well. And again, you can find us on all your favorite podcast channels as well. This interview will be on all those also. So whether it's Spotify or SoundCloud or any Apple iTunes, you can find this podcast there. Again, thank you so much for joining me as well as Axel Merk today. And we'll be back on the next edition of The Real Investment Show. Thank you again.